Okay, so for this video lecture, we will be discussing about measuring the performance of investment centers. Okay, so here there are normally different types of measurement being used for performance of the investment centers. Okay, so for this video lecture, we will focus on return on investment. Okay, so the performance measure will provide the direction for managers of the decentralized units, and they are also used to evaluate their performance. So this is where we can see if how investment center is performing, okay, in terms of revenues, cost, and the investment related transactions that they have, okay, during the accounting period, or depending on the time period of on which the management requires them to report the performance. So the development of the performance measures and specifications for receiving or giving the reward structure, these are normally the major issues that can affect the behavior of the managers. Okay, so it can either be motivating, or it can also lead into some of actions which are not legal, okay, in order for them to receive the reward. Okay, so the measures chosen should encourage goal congruence. So this should be the objective of the top management, especially for measuring the performance of each lower level manager, so that they will be able to avoid any unnecessary or negative actions of their managers. Okay, so goal congruence. So this is normally the objective that they should seek, okay, especially in choosing the performance measure. So what do we mean by goal congruence? So this means that the goals of the managers are also closely aligned with the goals of the firm, although they are given their authority, okay, with their areas of responsibilities. They can do anything, okay, that they have to do, but at the end of the day, they should make sure that uh, everything that they decide should be for the benefit of the organization as a whole, without uh, benefiting only their segment or division in harming other parts of the organization. So, a well chosen performance evaluation measures for investment centers are, we have the following: the return on investment or ROI, residual income, and economic value added or EVA. So, for this video lecture, as mentioned earlier, so we will focus more on return on investment. So, the rest of the evaluation measures will also have to be discussed in another video lectures. Okay, so for the return on investment, so since we are talking about investment center, so basically, this is also known as ROI. This is the most common measure for of the performance for an investment center. So basically, when we talk about investment, we always seek to know uh, how much will be the return, okay, for that investment. That's why ROI is considered to be the most common measure of the performance for our investment center. So ROI is useful both for external and internal um, purposes. Okay, and externally, this measure is used by the relative performance of the division. So how uh, efficient and effective they are in terms of return. Okay, so they can use this as a benchmark, okay, in evaluating also the performances of the different divisions. So your ROI can be uh, determined, okay, using the following formulas. Okay, So we have here, okay, 3 different methods on how you can determine or compute for ROI. So the first one is your operating income divided by your average operating income. Or we can also use this formula, operating income divided by sales. Okay, and we will multiply it with the quantity of sales over average operating assets. And the third formula is operating income margin, okay, times the operating asset turnover. So any of this formula, okay, we can use this in determining our return on investment. So if you could notice, we always have in the formula the income. Okay, so by the way, we use the operating income here, okay, as our factor or variable because we are talking about the return. So investment, okay, so we have here the assets, okay, and the sales as well. Okay, so to understand better, okay, later on we will have an example. So we will define what operating income is, okay, based on this 3 different formula. Okay, when we say operating income for the purpose of determining the return on investment, so we mean earnings before interest and income taxes. Okay, so that is what we, the figure that we should use. Income or earnings before interest and income taxes. Okay, so what about net income? So net income is used in the calculation of ROI for the company as a whole. But when talking about performance of the different divisions, we normally use the operating income. Okay, so please take note of that. Okay, so what about operating assets? Okay, operating assets include all assets used to generate the operating income. So the management should determine, okay, what assets do they normally use, okay, and that directly generates their operating income. So here, normally, what they include is or are the cash, receivables, inventories, land building, and equipment. So these are the most common assets, okay, that they use. Okay, for average operating assets. Okay, so how do you determine this one? So we have here the formula for determining the average operating assets. Okay, so all you have to do is to add the beginning net book value of your assets and the ending net book value of your operating assets, and we will divide it by 2. Okay, so this is how you average your operating assets. Okay, so to understand better, let us take this illustration to explain how to determine your ROI. Okay, so in this illustration, we are provided with this data, which includes the sales for the 2 divisions. We have snack and appliance divisions. Okay, so we also have operating income, okay, beginning and ending operating assets. Okay, so these are also important in determining the ROI. Okay, because we need to average these operating assets. Okay, so for the average operating assets, so this one is related to snack food division. So we will analyze first the snack food divisions. Okay, so the average assets of snack food division is $10 million. So for the margin, okay, so we have operating income divided by the sales, so that's 6%. Their turnover is 3. Okay, so to solve the ROI, we can use either of these two based on what we have mentioned earlier. Okay, so we have three formulas. So in this illustration, you can use either of the two. Okay, so margin times turnover. So here your ROI for snack food is 18%. Or using this formula, okay, it will also provide us with the same ROI of 18%. So therefore, based on the data, the snack food division has 18% return on investment. Okay, what about for appliance division? Okay, so for the appliance division, okay, so we have the following average operating assets. We've taken the data from the table. Okay, so their operating asset is 9,500,000. Okay, their margin is 3%. Whereas under the food snack it's 6%. Okay, their turnover is 6. Okay, by the way, when I say turnover, this is uh, the measure of how efficient does the division is in terms of sales, okay, upon using their assets. Okay, so for this ratio, the ideal ratio should be higher. So if you will compare these two divisions, the appliance division is better than the food snack division. Snack foods, I mean, because they have turnover of 6, whereas under the food snack we have only 3. Okay, so meaning to say they are better in terms of sales and in using their or upon using their assets. Okay, for the ROI, okay, so you can choose either of the three. So based on the data, so the ROI is the same with that of the snack food division, is also 18%. Okay, so although their ROI are the same, but they differ from the average operating assets, margin, and turnover. So depending on the decision or evaluation process or what do you call this evaluation merits of the management, okay, so they can decide if this division are doing well. Okay, so that's for return on investment.